India Business Insights. Today we are decoding the US tariff shock on Indian exports, now effectively 50% in two trenches, and what it means for our economy, jobs, trade balance, and strategy. We will break down what changed and when, the import-export fallout, GDP impact, how businesses can mitigate right now, and the policy moves India should consider next. We will also look at how US consumers and retailers are reacting. What exactly changed and on which dates? Over the last 10 days, Washington escalated tariffs on Indian goods in two steps. Initial 25% tariff announced around July 30 to 31, 2025, administration statement and wire reports. It was signaled to start in early August, pending the Federal Register process. A second 25% tariff was announced on August 6 to 7, 2025, lifting the total to 50% on many Indian goods. As per filings and legal notes, these trenches kick in after publication and a waiting period. The first trench around August 27, 2025, and the second August 28, 2025, 21 days after August 7, unless stayed by litigation. The White House linked the move to national security and Russia-related measures, framing tariffs as part of a broader pressure toolkit. Bottom line on dates. August 27, 2025, first 25% trench expected to enter into force after Federal Register timing. August 28, 2025, second 25% trench expected 21 days lag from August 7. If courts intervene, dates can shift. For now, plan on these. Immediate market reaction in India. Markets moved fast. Reports over the last few days flagged rupee weakness, risk off in some exporters, and safe haven buying in gold and silver. Commodity desks highlighted turbulence across metals and energy as traders priced in slower global trade. In trade-heavy states, sector associations warned of order holds and renegotiations, especially in textiles and gems and jewellery, with some clusters reporting sharp slowdowns ahead of the holiday season. Which sector get hit first? While HS line specifics matter company by company, the on-ground guidance and early industry comments point to textiles and apparel, home linens, carpets. India is deeply exposed to the US in these categories. Many MSMEs supply US retailers. 50% total duties can erase margins overnight. Gems and jewellery, including diamonds, the US often takes 30% of India's G&J exports. Jaipur and Gujarat hubs report stress, especially SEZ units that cannot sell domestically by default. Calls are growing to allow domestic diversion with duty adjustments for survival. Leather and footwear, chemicals, machinery parts, shrimp/seafood, early assessments flag steep exposure. Analysts warn 40 to 50% volume risk to US-bound orders if tariffs persist. Some commentary suggests smartphones and parts of pharma may be less affected in the initial lists, but firms should verify exact HS codes against the Federal Register once each trench is published. Do not assume carve-outs until you see your line. Scale of exposure and GDP math. In 2024, US goods imports from India were $87 to $91 billion, with total two-way trade near $129 billion. A sudden tariff wall at 50% chokes price competitiveness. A Reuters roundup packs $64 billion of Indian exports to the US at risk, roughly 2% of India's GDP, but remember, that's cross-trade, not value-add. RBI has so far kept its growth view intact near the mid-6, implying macro drag may be limited unless tariffs persist for multiple quarters. Separate commentary suggests 0.3% point downside to India's GDP if the shock lasts. India's imports and other spillovers. Tariffs are on Indian goods entering the US, so India's goods imports from the US aren't directly taxed by this move, unless New Delhi retaliates. The more immediate spillovers are FX, financing costs, working capital, and SEZ utilization constraints. Policy chatter also intersects with US de minimis tightening, recent reforms to sub $800 shipments, which hurts D2C/e-commerce exporters relying on small parcels. The US side prices, retailers, and inflation. For American consumers, tariffs are a tax at the border. Expect higher shelf prices in apparel, home textile, jewelry, and parts of furniture, carpets, as retailers either eat margins or pass costs. Economists warn this cycle of broad tariffs is inflationary. US media and broadcast analyses over the week have flagged the risk of higher CPI and weaker real disposable income. Retailers are already sounding out alternate sourcing, Mexico, Vietnam, even shifting some orders inside the US, but that raises costs in the short run. Public opinion snapshot. In India, industry bodies, textiles, gems and jewellery, MSME exporters have gone public with job loss concerns and have urged urgent relief. In the US, analysts and outlets point to broad skepticism about higher tariffs because of price impacts, though views track partisan lines. Net business groups on both sides are worried about costs and demand. Mitigation. What Indian companies should do this week. Step 1. HS code hygiene. Confirm exact HS code lines impacted in both trenches. Recode only if substantively accurate and compliant. Build landed cost calculators with 25% plus 25% scenarios through Q4. Step 2. Reprice and repackage. Push value engineered SKUs, smaller packs, or bundles to keep ticket prices steady. Step 3. Dual route sourcing. Explore nearshoring, Mexico for NAFTA/USMCA adjacency, or final finishing in low tariff hubs if truly value adding and compliant. Step 4. Cash flow defense. Lock export credit lines, trim inventory cycles, and secure FX hedges. Step 5. Channel mix. Where possible, pivot to EU/UK, holiday cycles still open, Middle East, select Asian markets. Step 6. G&J/CES. Keep documentation ready for possible domestic diversion if the government relaxes rules for CES unit temporarily. Policy options for India. Short term, engage Washington on carve-outs for sensitive lines, press for transitional relief as talks continue. Targeted support, faster ROTSTEP/Rostel refunds, interest subvention, and emergency working capital windows for tariff hit MSMEs. CES Flex, temporarily allow domestic sales for CES on payment of input duties, not full product value, to prevent closures. Medium term, accelerate FTAs, not just UK, but EU, Canada, Brazil, to reroute demand and lock in tariff certainty. Senior economists have publicly urged pushing harder on the EU FTA in particular. Logistics plus tariff reform. Chip away at domestic cost adders, freight, power, ports, and inverted duties to restore competitiveness. Long term, move up the value chain in textiles, leather, and machinery. Promote design-led, brand-led exports. Co-production for the US market, selective JVs, and capex in America for tariff-proof access where viable. Broaden services exports to cushion merchandise shocks. What could change the outlook? Legal challenges could delay or alter tariff implementation. Negotiated carve-outs or rollbacks remain possible if talks progress. Global demand. If US retailers see margin pain and consumer pushback, they will push harder for relief or resource at higher cost, which also pressures prices at home. To wrap up, this is a serious near-term shock to several Indian export engines, but it is also a call to de-risk and race for competitiveness. The next few weeks are about cash flow defense, channel pivots, and pinpoint policy relief. We will keep tracking the dates and the fine print so you can act, not react. If you found this useful, like, share, and subscribe to India Business Insights. Drop your sector and HS code in the comments. We will prioritize a sector-wise deep dive next.